Imagine waking up one morning and discovering that half of your life savings had vanished. No warning, no dramatic headline that everyone still talks about today. Just silence, followed by panic. Long before the crashes of 1987 or 2008 became famous, there was another financial disaster that erased billions of dollars, shattered confidence, and quietly changed the future of investing forever. Yet somehow, almost nobody remembers it. And the strangest part is that the forces behind that forgotten collapse are beginning to look disturbingly familiar today. In the early 1970s, America looked unstoppable. The economy had enjoyed decades of growth after World War II. Families were buying bigger homes, new cars filled driveways. Television commercials promised an even brighter future. Businesses expanded with confidence, and Wall Street seemed like the easiest place in the world to make money. Investors believed they had entered a new era where prosperity would continue almost forever. The optimism was so powerful that questioning it almost sounded foolish. But beneath that confidence, tiny cracks were already beginning to spread. Money flowed into the stock market faster than ever before. Pension funds, banks, and ordinary families all wanted a piece of the action. Stocks weren't just investments anymore, they became symbols of progress. Every successful company looked like it could grow forever. Investors stopped asking whether prices made sense. They only asked how much higher they could go. Greed quietly replaced caution, but almost nobody noticed because everyone around them was getting richer. And that false confidence was building something incredibly dangerous. One group of companies became the stars of Wall Street. They were known as the Nifty 50. These weren't small, risky businesses, they were household names. Companies like Coca Cola, IBM, McDonald's, Polaroid, Xerox, Disney, Johnson& Johnson, and Avon. Investors believed these businesses were so perfect that they could be bought at any price. Analysts even described them as one decision stocks. The only decision you supposedly needed to make was to buy them and never sell. It sounded almost magical, but the real problem was just beginning. Imagine paying almost any price for a company simply because everyone believed it could never fail. Some of these stocks traded at price to earnings ratios above 50, 60, or even 90. That meant investors were paying enormous premiums for future growth that hadn't happened yet. Nobody cared. Every new record high convinced people they had been right all along. Success fed confidence. Confidence fed greed. Greed pushed prices even higher. The cycle became self reinforcing, and almost nobody stopped to ask the most important question of all: what if perfection was already priced in? At first, there was no reason to worry. Corporate profits looked healthy. Consumers kept spending. Businesses kept expanding. Newspapers celebrated America's economic strength. Wall Street analysts predicted even brighter years ahead. Investors who stayed cautious watched friends become wealthier. Fear of missing out became stronger than fear of losing money. Even experienced professionals started believing the rules had changed forever. History, they thought, no longer applied. But nobody could have predicted what came next. Far away from trading floors, another crisis was quietly taking shape. Inflation had started creeping higher. Prices for everyday goods slowly increased. It wasn't dramatic enough to cause panic, but it was persistent enough to worry economists. At the same time, government spending remained high, and years of easy money had begun creating pressure beneath the surface. The economy looked healthy from a distance, but underneath it was becoming increasingly unstable. Most investors ignored these warning signs because stock prices continued climbing. Then another shock arrived. In 1971, President Richard Nixon made a decision that would change global finance forever. The United States suspended the dollar's convertibility into gold, effectively ending the Bretton Woods monetary system. It was one of the most significant financial decisions of the 20th century. Many people didn't fully understand its importance at the time. Markets barely reacted at first. Life continued. Businesses kept growing. Investors kept buying. But the foundation beneath the financial system had shifted in ways that would soon become impossible to ignore. Meanwhile, inflation refused to disappear. Interest rates began moving higher. Borrowing became more expensive. Companies faced rising costs. Consumers started feeling pressure. The economy wasn't collapsing yet, but the conditions that had fueled years of effortless growth were slowly disappearing. Investors, however, remained convinced that the biggest companies could overcome anything. Confidence became stubborn. Reality was becoming something people simply didn't want to hear. Then came 1973. In October, another crisis exploded across the world. Following the Yom Kippur War, several Arab members of OPEC imposed an oil embargo against nations supporting Israel. Almost overnight, oil prices surged dramatically. Gas stations faced shortages. Long lines formed across America. Drivers waited for hours, hoping to fill their tanks. Some stations simply ran out of fuel. The modern economy depended on cheap energy, and suddenly that assumption disappeared. What happened next shocked everyone. Factories faced rising costs. Airlines struggled. Transportation became more expensive. Food prices climbed. Inflation accelerated even further. Businesses that once looked unstoppable suddenly found themselves squeezed from every direction. Higher costs reduced profits. Consumers spent less. Economic growth slowed rapidly. Yet many investors still believed the downturn would be temporary. They had seen small corrections before. This, they thought, would be no different. But the market had already begun turning. At first, the declines looked manageable. A few bad weeks, then a few bad months. Investors told themselves it was simply another buying opportunity. Financial advisors encouraged patience. Television experts reminded everyone that quality companies always recovered. But each rally failed. Every attempt to regain confidence ended with another wave of selling. Slowly, disbelief turned into anxiety. Then anxiety became fear. The famous Nifty 50 companies that investors believed could never disappoint started falling. Not because they suddenly became terrible businesses, but because investors had paid far too much for them. Even great companies can become terrible investments when purchased at impossible prices. That simple truth had been forgotten during the boom years. Now the market was forcing everyone to remember it. Polaroid, once considered nearly untouchable, suffered devastating losses. Xerox, another market favorite, collapsed. Avon, celebrated as a growth miracle, plunged. Countless investors watched companies they believed were perfectly safe lose massive portions of their value. Some stocks fell by more than 60%, others lost even more. The companies survived, many remained successful businesses. But shareholders paid a painful price for believing that any stock was worth buying at any valuation. This single mistake changed everything. Selling accelerated across Wall Street. Every decline triggered more fear. Investors who once refused to sell at any price suddenly wanted out immediately. Mutual funds faced redemption requests. professional managers dumped stocks to raise cash. Banks grew nervous. Credit tightened. Confidence, which had taken years to build, disappeared with shocking speed. The Dow Jones Industrial Average eventually lost around 45% of its value from its peak to its bottom. For many investors, the damage felt even worse because popular growth stocks often declined much further. Retirement accounts shrank, college savings disappeared, families postponed major purchases. Some investors swore they would never own stocks again. The emotional scars lasted far longer than the numbers themselves. But perhaps the most dangerous part wasn't the falling prices, it was the uncertainty. Nobody knew how bad things could become. Every newspaper carried another frightening headline. Inflation remained painfully high. Unemployment increased. Businesses closed. Economists argued over what should happen next. The combination of slow economic growth and high inflation created something many experts believed shouldn't even exist. They called it stagflation, and it challenged decades of economic thinking. Investors who had grown up believing stocks always recovered quickly suddenly faced years of disappointment. Markets didn't bounce back overnight. Hope returned only to disappear again. Every small recovery tempted investors back into the market before another decline crushed optimism once more. Emotion replaced discipline. Decisions became driven by fear instead of strategy. Many ordinary people blamed themselves. They believed they had picked the wrong companies. But the deeper problem wasn't necessarily the businesses, it was the prices they had paid. Even the strongest company cannot protect investors who ignore valuation. Buying an incredible business at an unreasonable price often leads to years of disappointing returns. That lesson cost millions of people enormous amounts of money during the 1973-1974 crash. The emotional damage spread beyond Wall Street. Families cut spending, small businesses delayed expansion, workers worried about layoffs, newspapers questioned whether America's greatest years had already passed. Confidence became incredibly difficult to rebuild. Once people lose faith in the future, economic recovery becomes much harder than simply fixing financial numbers. Years later, many of those companies recovered. Some even became legendary investments once again. McDonald's expanded across the globe. Coca-Cola strengthened its worldwide dominance. Johnson& and Johnson continued growing. Disney reinvented itself. But investors who bought near the peak often waited many years before simply breaking even. Time eventually healed businesses. It did not erase the pain of overpaying. That's one reason this crash quietly disappeared from public memory. Unlike the Great Depression, banks didn't collapse everywhere. Unlike 1987, there wasn't a single dramatic one-day crash. Unlike 2008, there wasn't one obvious villain that everyone blamed. Instead, it was a slow, painful unraveling, driven by excessive optimism, unrealistic expectations, inflation, geopolitical shocks, and one dangerous belief that great companies could justify any price. History moved on. New bull markets eventually arrived. Fresh generations entered Wall Street. And as memories faded, familiar patterns quietly returned. Again and again. The dot-com bubble, the housing boom, cryptocurrency manias, artificial intelligence excitement. Different technologies, different headlines, different decades. Yet the same emotions. Greed whispers that this time is different. Fear insists you'll miss out forever. Confidence convinces smart people they no longer need caution. Then reality arrives without asking permission. Markets have always rewarded patience, but they have also punished arrogance. They have rewarded discipline, but they have punished blind optimism. Every generation believes it has discovered a shortcut to wealth. Every generation eventually learns that risk never truly disappears. It only hides behind rising prices until everyone forgets it's there. Perhaps that's why the 1973 crash deserves to be remembered. Not because it was the biggest, not because it was the most famous, but because it revealed one of investing's most uncomfortable truths. You don't lose money only by buying bad companies. Sometimes you lose money by buying wonderful companies at terrible prices. That's a lesson people continue relearning every few decades. The market doesn't care how confident investors feel. It doesn't reward popularity. It doesn't protect people simply because everyone agrees. It eventually forces prices back toward reality, no matter how exciting the story may be. When crowds become convinced that risk has disappeared, risk is often at its highest. When everyone believes prices can only move upward, history quietly begins preparing its next surprise. And when investors stop asking what something is truly worth, they unknowingly step onto the same path walked by millions before them. The forgotten crash of 1973 wasn't just a financial disaster. It was a reminder that markets are powered as much by human emotion as by economic data. Fear, greed, hope, ambition, pressure, and desperation have shaped every boom and every collapse throughout history. Technology changes, governments change, industries change. Human nature rarely does. Maybe that's why the most dangerous words in investing have never been the market is falling. They are far more seductive. This time is different. Every forgotten crash once began with those exact feelings, and every future crash will probably begin the same way.